This is Solomon Davis, Right Side Trader. Today is February 10th, 2024, and this is a week, not even a weekly. This is a trade. This is kind of like going over some things that I had said. I usually don't say things like this because this is all for educational purposes only. As I always say, no trade recommendation. You should check with your financial advisor. Trading is risky because you can lose money at trading. So usually I don't like calling out too many numbers. That's intentionally because people say Solomon said this is da 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 da. But last week, as you can see down on one of my shorts, I said SPY going to 500, and one guy, as soon as I said that, somebody reached out to me and said, "Oh, so you think so?" Pretty much. He didn't say exactly that, but I say, yeah, I think it's close enough. I think it should reach 500, and it did. That's all. I'm gonna just leave it at that. But now, what I'm gonna do, I'm gonna give you some things, ways that it could have been traded. This is all for educational purposes only. How you could have traded the SPY to 500, because the thing is, this is all about trading and all, and seeing the market and seeing what's happening in the market. So let me just jump over to some things right quick here. Let me start something up here and show you some things here. And it's going to be with options. Options are probably the most riskiest things that you can actually trade out there. So I'm going to talk a little bit about options, and I'm also going to look at the stock itself. All right, let's go ahead and take a quick look at this. SPY to 500, Solomon said, February 5th. That was last weekend, so it would have been Monday that people would have actually been doing stuff. One of the things that you could have done, based off of what Solomon said, was to buy the stock. Again, no trade recommendation. Anything that I say out there is for educational purposes only, because trading is risky. So I keep saying that. Don't do your own due diligence. Look into everything yourself and make sure it makes sense to you to put your money at risk. But now, I'm going to go over this. You could have bought the stock at 493 and expecting it to go to 500. You could have bought the stock and sold the call. This is one of the strategies that I like doing, is buying the stock and selling a call. And that's SC open, selling a call to open. The other thing that you could have did, you could have bought a call. A lot of people who like trading options, they like buying options. Me, I really don't like buying options, but I do every now and then when I see something and the options look okay to me. Now, that whole thing about options looking okay, that's a whole nother ballpark when it comes to actually buying options. And that's why I don't like talking about options, because options for different products out there can be the worst thing that you can actually get yourself into if you don't know what you're looking at. And the BCO is buy to open, and the ATM is buying a call to open at the money, or buying a call to open that is out of the money call at the money call. The at the money call at that time on February 5th would have been at 493. If you'd have been looking to buy an out of the money call, I'm just using the 500 number since I said 500, and like I say, this is for educational purposes only. You could have, based on your strategy, your plan, and ever how you do things with options, you could have picked a different strike. The thing is, there are strikes when it comes to options. I'm not going to get that deep into options. Just saying 500 is the number that I chose here. The other strategy that you could have did, some people like selling options. That's the thing. So when you sell something, you collect money. Some people like collecting money. Some people seem like they like spending money. But there's a lot of people who like collecting money. But this particular strategy takes a lot of money in order to do this strategy, selling a strangle. And selling a strangle, what strikes do you sell? And I'm going to talk a little bit about the strikes that I would sell if I was selling a strangle, and let you take a look at why I don't do this trade. And I didn't do this trade here at all anyway. Me, I prefer to actually trade the Russell and trade the NASDAQ, as you know, who've been following me for a while. QQQ is my thing that I like trading. And recently, you notice that I talk a lot about the Russell. The Russell has become something else that I like trading. I have traded the SPY in the past, but the SPY is not my go-to thing to actually trade. QQQ or the Russell is more my go-to things to actually trade. But the other thing the other strategy, and all these are pretty much bullish strategies. This is kind of like a pretty much neutral strategy when you're selling a strangle. You're just expecting the stock to stay within a range. And also that's okay. But then selling a put is a strong bullish strategy. And selling a put, again, I would sell it at 500. I'm saying at 500, that's again me, what I would do, maybe not what you should do. And this is I talked with another trader years ago, and he was telling me how he sold, his puts in the money. I said, whoa, because usually you don't hear about that, and you go to any school or read any books, they're talking about selling puts, at the money or out of the money type strategies. But this one particular trader, he was selling his puts in the money, but he was selling it on stocks that he expected to go up and stocks that he didn't mind owning at that price and all. And he was a long-term trader. He was holding things for years, not for a week, not for a few minutes, not for a few months. He was holding stuff for years. So his time frame was completely different. But I kind of adapted for my little short time frame that I like doing from time to time with different things that I don't mind trading at times. But let's go ahead and take a quick look at the charts and see how all these different strategies would have played out. Okay, so I'm flipping over to the charts. I hope you can see my charts at this time. Where's my other little thing to show me what I am actually seeing? You should be seeing the charts and all. And this was Monday, and this was the stock price on Monday at 493. This is the line at 493. The price went well below that, went above that a little bit, ended up closing somewhere below that. I'm saying 493 was the number that I was looking at and all if I would have been actually placing this trade. So I would have been able to purchase the stock at that price. The next trade that I said was selling a call for Friday's expiration on that stock that now I had purchased. On Monday, me selling that stock, selling that call, I could have got anywhere. This is the 50-cent line, and as you can see, it was above 50 cents. I could have sold it for a little below, above that. Because again, when you're selling options, you want to sell at a high price, and you want to be able to buy it back at a low price. And if you want it to expire worthless. If you're holding stock though, and you're selling a call, you're going to have to be willing to sell your stock at the strike that you are selling it at. And me, in this particular case, I was okay selling my stock at $500 a share. The other thing with this particular strategy, if you're buying stock and selling a call, you have to be able to buy 500 shares of stock. So that trade would cost you $50,000. Well, no, it wouldn't cost you no 50. Yeah, it would have cost you $49,300 to buy that 100 shares of that stock on Monday at the price that I was looking at, that 493. And then all you would collect, for selling that call was $50. But your expectation was this stock was going to go to $500, so you was expecting to make at least, $700 on the stock and an extra $50 on the call that you actually sold. So that's that trade. Now, the other trade that I was talking about was buying an at-the-money call. Buying an at-the-money call on Monday, this particular day here, you could have purchased a call for around $2.80. This, as you can see, this is the chart. This is an option chart, so I'm looking at. That's why I'm putting this number up here, and this is what we are looking at. This shows you that it did trade around that price. I'm saying it did. That option price did drop. You could have got a better price, but based on my trading strategies and how I look at things, the price that I probably would have got to been closer to this around this $2.80 price. So buying that call for $2.80 per contract and watching it go all the way up to over $8 by Friday. That was another strat. That was one of the other strategies. And then the other strategy that I said that you could have done, you could have bought a call out of the money. And if you'd have purchased that call out of the money, the thing that comes up, strike selection, and since I said I was expecting it to go to 500, I'll pick a $500 strike and all. But one of the things that I want to mention about, since this is no trade recommendation, I do not trade options like this when it comes to buying options. One of my key things about buying options is when you buy an option, give yourself enough time to be right. One day, this expiration on this particular option is on Monday, the Friday, then the Monday after that Friday, it's expiring. That's not a good idea. In this particular case, it did happen to work out and all, but that's not going to work out most of the times and all. In this case, it happened to did. It did. But going back on Monday, looking at these options and buying that out of money option, maybe I wouldn't mind doing that particular trade if I'm only spending, buying a $500 strike for only 50 cents. That's $50, and taking a chance to actually make some money if this thing actually moved in the direction that I expected to move. And in this particular case, as you can see, it would have been no problem buying that option for 50 cents. It traded the next day also for 50 cents less and more, and then it more than doubled its money. Had a high on Friday of over $2 a share on Friday, over $2 a share. Now, the other strategy that I also mentioned that you could have did was a strangle. On the strangle, is selling a call and selling a put. Now the thing is, what call do you sell? What put do you sell? Me, based on my trading plans and my trading strategies, I usually don't like giving myself too much time, so this is closer to what I would normally do, but this is not exactly what I would normally do. But in this presentation that I'm giving in what I'm showing here, I'm showing something based on expiring that Friday, since Solomon said it was going to 500. I don't want to be in this trade no longer than this week and see what happens type thing. If you would have sold that call, and the other thing now, when you're selling an option, selling a call option, you want the market to close below that call that you sold if you don't have the stock. If you're doing a strangle, doing a naked strangle, that's why I'm saying most brokers are not going to allow you to do this trade, because this trade can go really, really bad. GameStop, I'll just say that. So, me, with an index, I don't expect it. I expected it to go to 500, but I didn't know how much more over 500 that it would go. The other thing that I normally would do, if it starts getting close to my strike, I get to my strike and all, I'm going to roll it out. In this particular case, for demonstration purposes only and education purposes only, I did choose a 503 strike. You would have only collected 20 cents for that call on Monday. This is the 20-cent point on Monday. And you can see the worst case on that particular option that you actually sold, it went, you would have had to give back your 20 cents and another 25 cents on it, worst case and all. Although it did ended up, the market did end it up closing below 503, so you would have been okay on that trade at closing and would have been able to close it for a nickel or less. But now the other side of that trade is the put for the strangle. On the put makes it all worthwhile, and this way I like doing it. If I'm gonna sell an option, if I'm gonna sell an option, first of all, on the call side, I want to own the stock. Just my personal preferences. If I'm gonna sell a put, I'm gonna sell it at a strike that I don't mind owning the stock. In this particular case, I was expecting the stock to go up to 500, so I didn't mind owning it at 500. Now the thing is, can I collect a little bit of money on it while it goes up to that point? This is what a guy explained to me one time. He said, if you don't mind owning the stock, go ahead and buy it outright, and watch it go up. If you don't mind owning the stock at a certain price, sell a put at that price that you don't mind owning it at, and you would get a little bit extra money for owning that stock once it does get to that price. If it closes below that, below that strike, and you have to actually purchase that stock at $500, you would have spent the $50,000 or maybe a little bit less, but you didn't mind spending the $50,000. You already had it in your account. You got to do 100 shares. That's where the $50,000 is coming from. You hear me saying 50,000? Because to sell that option, you buying 100 shares of that stock. Now, the other thing, if it goes above that, you get to keep that $750. So you did get to participate in that move. Maybe you didn't get to participate in that full move since it closed $1 above, but you only missed out on $100. You didn't miss out on that much. You really didn't miss out on anything because you made money. That's the way I look at it. And you can do it again. So in this particular case, as you can see, selling that put, I was able to collect $7.50. The market did actually end up going above, closing above $500 a share, and I would have been able to close this put on Friday at 5 cents or less. So that's pretty much it on the trades. Let's go ahead and kind of sum it up here. The plan was to buy the stock. At close, I could have purchased the stock at $493, $403.90 a share. It closed on Friday at 501. I would have made $8 on that per share of stock that I actually purchased. I purchased 100 shares, of that stock. That what I was willing to spend. That $49,300 in the beginning, and then close that trade. Since I only wanted to just do this trade just to see how it worked based on what Solomon said. Don't do this. This is not a trade recommendation. This is just me going through something and all. And I would have made $800 that week, based on what Solomon said. Now the other strategy that could have been done was buying the stock and selling the call. Again, you would have to spend that $49,300 to purchase 100 shares of the stock. It would have allowed you to been able to sell. Your broker wouldn't have had any problem you selling a call at the $500 strike, since you own the strike, and only collecting 50 cents. Your profit on that trade would have been, since it closed at, back up. Since it closed at 501, you would have had to sell your stock at $500. So you still would have made $7 a share. So that's $700 plus the $50 that you made. So the difference between those numbers and all is $750. You should be around $750. Make sure I did the math right there, guys. I don't know if I did or didn't at all. So now, buying the call. Buying the call, there's two ways you could have bought the call and the way people like buying the call. Some people like buying the call at the money, in the money, like that. Or all I'm showing is if you'd have bought the call at the money, or if you bought a call out of the money at the number that I said it was going to go to, $500. So an at the money call on Monday would have cost you $2.80, like I showed. That would have cost you $280 per contract. You would have easily been able to close that contract for $8, per contract, and you would have made $5.20 per contract. That's $520 per contract that you could have made on that. If you'd have brought an out of the money call at the $500 strike, you would only pay 50 cents per contract. That's $50 per contract, and you could have easily been able to close that trade for $2 per contract, making $1.50 per contract. That's $150 per contract that you could have made on that trade. Now on the Strangle was the funny one. The Strangle, and plus I did it the way I like doing stuff. Again, if I have the money to buy the stock, and I'll at $500 a share, and I'll sell it at $500 a share, I don't mind selling a put at the $500 strike. I have the cash in my account to be able to do that. You have to have the cash in your account to be able to do that. So again, I was able to sell the put for $7.50, which equates to per contract is, again, and per $50,000 that you have, is $750. The call on the call side, I was only able to sell that call for only $20, but then my net profit on this trade, I say I close it for a nickel a contract. That's how I come up with this $760 on that particular trade. You see $770 here, $10 less is for the closing, and you also in all cases here, you need to take in your commission also, whatever that may be. So doing the iron condor, I didn't want to get into that because when I do the iron condors, if I'm doing an iron condor, sometimes I might do the SPX, and sometimes I might do the SPY. I actually prefer to do SPX, but I didn't want to get into all those numbers, and I didn't want to switch over. I just wanted to stick with the SPY. So that's why I didn't do that. Now, again, selling the naked put is just like what we had saw up there before. It's going to require you to have, if you're in a cash, and all this kind of like based off of a cash account. But like this one trade, like I said here, the Strangle, you're probably going to have a margin account in order to do that trade, But on selling the put in a cash account, you're going to have $50,000 in order to actually place this trade. And you sell that at that $500 strike, you would have collected $750. And since it closed above that, you get to keep that whole $750, and you keep your $50,000 and do the trade again. And that's pretty much it. That's all I really want to share. I hope this is being helpful. Hope you kind of like this kind of stuff. If you do and you want me to do more things like this, I will. I don't mind doing it. I'm trying to do it at least once a month, something a little bit different than just my weekly reviews. So just let me know what you do. Do like, get more people to subscribe, and I'll do more stuff like this. Again, hope you guys had a great week. Hope you guys having a great weekend, and I'll talk to you next week. Have a good one. Bye.